All right. Hello, everyone, and welcome to another exciting episode of the Daily High. I'm your host, Tone Face, another solo show today while Matt is working from Bali, Indonesia. Now, with yesterday's audio difficulties, I have no idea if my mic is good or not because I don't have a co-host. Therefore, I'm relying on the live chat to let me know if this Rode microphone that I'm wearing, again, it's $300 mic, is working properly or not. Actually, I'm not using this mic. I'm using my webcam. Let's see what happens if I use the mic. Is it going to work? Let me know if this is better or it was better the way I started the show. And then whichever one's better, uh, we will keep to that. All right. Well, for now, I'm going to stick with this. Um, okay, it's better. Much better. Okay, good. All right, so we're sticking with this then. All right, so let's go to the price action and see what's going on. So the most important thing to keep in mind is Jerome Powell will be speaking from Jackson Hole in 9 minutes. So maybe we will stick around and watch it. I'm not sure. These videos usually try to stay short. Maybe I'll come back on the channel and maybe I'll come back on a channel with another stream. We'll see. I actually have no idea how long these speeches are. I don't normally watch them, but this time I might because it's super, super interesting. Weekly chart. Sorry, monthly chart. Oh, as you can see, the red star has disappeared. I don't know why it took so long for the red star to disappear. Once the price action was no longer at lower lows, the red star should have been gone. Not sure what took so long. But the red star is gone, and we are working with a green tone-based value. And that's a good sign. It's a good sign that the lows could be in. Man, the moment the next month's candle starts trading higher than current candle, I think we're going to get to 100K fairly quickly. Let's go to the weekly chart as the week comes to an end. We do have a nice week right here. However, we're still dealing with a red count on the MRI. We still haven't broken a declining moving average. We're still in a very clear downtrend, and we haven't even broken last week's swing high. These are all negative factors, but it's a good start that is setting us up for next week. I'm not expecting anything major over the weekend. So if anything happens, it's going to happen as of Monday. It's possible we have a good weekend, but there's no way I am adjusting my allocation until we are above the long-term moving average. And this time around, I'm probably going to go leverage long, just so everyone's aware. The daily chart. I think that daily chart is getting way too cluttered. I'm going to move these things over so that they're not in my way. But you still have a general idea on what I'm thinking based on what kind of consolidation we have. The reason I want to get them out the way, and this was a very good call. I'm going to delete this as well. I just want to unclutter the chart. I'm even going to drop the alphanumerics for a little bit in order to draw one of my favorite patterns. And that favorite pattern is the ascending triangle. which looks absolutely perfect. This is an incredibly accurate ascending triangle. This is probably the most bullish thing we have, is this ascending triangle. It's the only thing that may convince me to go long later today. If today's candle starts, if around 4, if by 4 p.m. today, or let's say by 2 p.m. today, Bitcoin is at $62,500, I will be entering a little bit long because that would put us right under the long-term moving average going into the weekend. But it's this ascending triangle on the daily that would do it. This is great. We have clearly have 1, 2, and pretty much 3 additional points on the upward sloping side. And we clearly have 1, 2, and 3 points on the horizontal side. We can now see how far we've fallen. That's a $9,000 move. And now we flip that upwards into a $9,000 move. This is basically what we are looking at off of this ascending triangle. I'm going to color this in green. And this to me is perhaps the most interesting thing that is happening in the price action right now. Now we're also halfway up the MRI count. So another option is we break out a little bit, hit an MRI top near the 128-day moving average, pull back to the area of the breakout being 61,000, 61 and a half, and then from there do the proper breakout. Powell is speaking in 4 minutes. Let's just go through the rest of the charts. I'm waiting for my sustained close above this blue line, which is at $62,500. I need the sustained close. But if we end up, if off of Powell's speech, Bitcoin ends up doing something like this or like this, that is going to potentially change my mind. I may go live later today. Well, I may go live later today on my personal channel to talk about either the Trump failed assassination or the latest in Asia Pacific, because the last stream was about Israel-Iran conflict and the prior one was about Russia-Ukraine. And a lot of people were interested in Latin America and Venezuela. No, I would not leverage today. If I'm entering today, I would enter between, I would say 30 and 50%, and the leverage comes later when we're breaking 64,000. Oh, shout out to Ocean Mining Pool. They mined 5 blocks in the last 2 days. That is incredible. Guys, you should get on this, the only legit mining pool left in the world, and it really needs some more hash rate. If you want to save Bitcoin, this should be the pool you're mining on. Nothing else. The cycle chart, we're still low. Would be nice if we end up popping to 74, we'll be right in line with the prior 2 cycles. Oil, not that interesting. Gold continues off of its top. I believe gold has topped for the month, and it will probably break it sometime at the end of next month. S&P 500 pulled back a smidge. This is the weekly scale. Let's go to the daily. S&P 500 marked the top as well on the MRI top. I think we'll be breaking to all-time highs next week. I see this as a 1 to 4 candle correction off the MRI. I see it more as something like what happened back in May. Nothing too crazy. This one didn't even top. And I don't see it as something like what happened in July. I don't see us going into a full-blown MRI buy. I see us as pulling back, consolidating, and breaking out. Powell is live. Let's go and take a look. Well, doesn't exactly look like Powell, so keep me posted. Though he's a little woke, it's possible that's Powell. No, he's right there. We're going to keep an eye on this yield curve all the way into the next Fed announcement. Let me see what the latest CME projections are. And we're going to see these adjust. After what oh, look at that. How about that? This used to be 50-50. And now it is 73.26. I bet you after today's announcements, this is going to drop all the way to like 10%. And this is going to be up to 90%. I still believe he's going to cut the rate by 25 basis points and never again. Well, eventually ever again, but never again this year. I think this is the one and only rate cut this year, and I think it's still coming. The only thing that's going to stop him from lowering the rate is the amazing rally in the S&P 500. If the S&P was down here at the longer term moving average, he would have cut the rate by 50 basis points. But because it's S&P could be at a new all-time high by the time the rate cut comes around, he may not cut at all. I wouldn't be surprised if he doesn't cut at all. Let's go to the 5-minute chart and keep an eye on a 10 a.m. reversal. Powell is about to speak, and look at this rally. Don't expect a 10 a.m. reversal today because we're going to wait and see what Powell says. He's still not speaking, though this isn't live. Now he's speaking. Okay, let's go hear what he has to say. Let's see what he has to say. Can you guys hear this?
Thank you, Karen, and thanks to our host from the Kansas City Fed. It's great to be back here today. 4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price inflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress, and a monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment. In the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gabby Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021.
Good bullet.
Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand.
Someone that understands that the majority of inflation was caused by the government and their shutdown of life, creating a supply chain problem.
Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns.
He's given us a history lesson. Like, I know all of this. Like, what are you going to do going forward is the question. That's what everybody wants to know.
In China. Higher rates of inflation were a global phenomenon reflecting common experiences. Rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade. But labor supply remained constrained, and in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. And inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023, and we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. as labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
Is that it? No questions? He didn't say anything. I mean, he said a lot, but he didn't really say anything. Well, we had a good trade, theoretically. Oh boy, here we go. It all ended on a 1 minute MRI top. I was just putting in a profit take too. I just had it up there. I haven't decided where I was going to put it yet. And while I was putting the line in, the whole thing just flipped. If I wasn't drawing lines and actually trading, I probably would have just got out the moment this giant candle started to form, but that's pretty much where I would have got out. No, you didn't say anything. Wow. So that was useless. I still think he's going to lower the interest rate by 25 basis points. And there's going to be more economic data coming in as well. So we can close this. And the markets are now going down. Okay. So you saw what I did on the trading side. I probably would have done the same thing over here at exactly 10 a.m. when it was breaking out above this high. That's also another very good entry point, but I wasn't paying attention to the market then. Not on a 1 minute chart. So the next chance I had to enter was right here at the break of the prior swing highs coming off the reversal candle. The MRI is not that relevant on a 1-minute chart, but certainly helps when it gives me a green star candle. And then I just raised my stop loss, and I eventually was putting in a 50% take profit. I was going to put it in around here, around 62.5, because then I'd expect a pullback, but it started to pull back when people realized that he wasn't going to say anything, and it turned. So I'm going to delete all these so that they don't clutter my chart. You guys saw them live on air. I'm going to delete all these lines. Would have been nicer if the entry was here, and then the stop loss moves up to this swing low at the next rail. This is where you can double down on your trade, actually. And then the rest of it goes the same way. I still think this is good. Let's go to the higher level time frames. On a 5-minute time frame, this looks good. We are almost at this line. Let's go to the 1 hour. The 1 hour looks pretty good. I mean, we do need to close this hour above the most recent hourly high. I think we will. If we can close this hour above this and prevent this hourly candle, it still has 40 minutes to go. Prevent this hourly candle from having a negative tone-based volume, make it a positive tone-based volume, a green tone-based volume spike. It would need to be closer to 62,000 for that to get a green volume spike. That'd be nice. And on the S&P, well, same exact thing. The charts look actually identical. I'm going to get rid of this. And we're going to call it a day. Thank you so much for watching, guys. Why would Bitcoin pump if you didn't confirm a rate cut? You don't need a rate cut for markets to go up, right? It has, remember, the S&P 500, the last time the Fed lowered the interest rate, let's see. Here's the Fed funds rate. The last time the Federal Reserve lowered the interest rate was on April of 2020. April 2020 was the last time the interest rate was lowered. So if we go and look at the stock market, what has the stock market done since April of 2020? Well, let's go to the weekly chart in order to find April of 2020. Damn, that's over here, right? That is April of 2020, right around here. That's May. So maybe I have to go to the monthly chart. Wow. Monthly chart. The last time the Federal Reserve lowered the interest rate was April of 2020. So if the only reason why the stock market rises is because the Fed lowers the interest rate, can someone explain to me how this happened? The stock market has doubled in price without a single interest rate lowering. Like, this is the stupidity of people that tell you that market only rises when interest rates are low. Like, explain how the market has doubled without an interest rate lowering. So the market doesn't have to rise for the reason people think it rises. Okay? The stock market is going to go up regardless of the interest rate. And if he's going to lower the interest rate, he may only lower the interest rate because inflation is down. The Fed lowers the interest rate because the stock market crashes. It doesn't lower the and it needs to help the stock market to stop falling. That's why the interest rate is lowered to begin with. Keep that in mind. So he doesn't have to lower the interest rate here but I believe that he will. Just one time, for multiple reasons that we constantly discuss in Twitter Spaces. One final peek at Bitcoin, and here we are. We are on a green volume spike. So all we have to do is close this hour above this line and get us above 62.5, and I will pick up a little bit into my portfolio. Mostly because I really like this breakout from the ascending triangle. All right, guys, thank you all so much for watching. Not to mention, I think we're about to enter this type of consolidation. I think this is coming. All right. Thank you all for watching, guys, and we'll see you all on Monday on this channel. We'll do a show with Mark Wood next week. Couldn't get it done this week. Bye, guys.